In this video, we will discuss the DR-IDR strategy. We will also then backtest a modified version of the DR-IDR and look at how it can be adapted specifically to trade gold. Stick around to the end to receive a free expert advisor to use for your own trading strategies. So, to kick us off, the DR-IDR has been recently popularized on YouTube by a channel known as The Master with a 7. I personally heard about it first from Artie from the Moving Average, who is one of the most popular trading YouTube personalities. And it's a very interesting strategy because it discusses using time-based strategies and time-based ranges to give you a very, very high probability trade setup. And it's something which is very mechanical and very easy to follow. So people have really gravitated towards the teachings. So to first kick off this video, we will discuss the original strategy, and then we will discuss how it can be modified to be used in an algorithmic trading context. The DR-IDR is based on the defining range, the DR, and the implied defining range, or the IDR. The defining range is effectively taking the first hour of a session. Originally it's used for the New York equity session, and drawing a box or defining a range on the highs and the lows of the session. And that would define the defining range. The IDR, or implied defining range, uses effectively the same concept, but instead of taking the highs and the lows, it would take the bodies of the candles, so the opens and the closes. And the concept behind this is that the first hour of each session really sets the tone for the rest of the day. And that's when, usually in the first hour, when volumes are the highest, when there's significant volatility, and the range created by that initial highly volatile, high volume time period can often set a key range for the rest of the day, which people will then trade off of. And as mentioned, the original DR, which the master discusses, is the first hour of the New York equity session. So this is 9:30 a.m. Eastern Standard Time to 10:30 a.m. Eastern Standard Time. And because this is the most widely used of the three, despite we have tested all of them, this will be the main topic of this video. So now, just to look at it in a visual basis, here's a chart from TradingView. And you can see here that the solid black lines would define the DR, whereas the dotted lines represent the IDR. And this would be a perfect example of, you can see it for the different sessions, including we have the London session, the New York session, and we have the Tokyo session. And what he's essentially saying is that this sets the tone for the rest of the day. And the concept of DR-IDR, it has been recirculated a lot recently, but I encourage you to also Google initial balance, as it's effectively the exact same concept as the DR, but it has been used in equity markets for a very long period of time. Initial balance is one of the most common trading strategies, which is used generally speaking by equities day traders, and DR-IDR has been further adding to it, but targeted more towards, I'd say, the Forex and CFD markets. But just all of this to say that this is a tried and tested strategy which has been around for a long time, and that really piqued my interest in backtesting it as well. So the original rules in the most popular video from the master is that effectively, if price, once that first hour is over, closes above the defining range, there is an 88% probability that the low of the DR is now the low of the day. And inversely, if the price closes below the DR, there is now an 88% probability that the high of the DR is now the high of the day. And this makes sense, right? Like, let's take the first example. If the DR sets the tone of the day, and now we know that price is above the DR, that means that likely it won't come back to the low created in the DR, because this might be more of an uptrend day, right? And he also, the master, prefaces in his videos that this does not apply to high impact news days, which would make perfect sense. If you watch our videos on news, this is a great example where fundamentals really drive price movements on high impact news days, whereas on more of a slower day, it can be really the auction mechanism between buyers and sellers which cause price to move in a certain direction. As the DR tries to model those behaviors of buyers and sellers, it's very logical that on very, very fundamentally driven days, it would not apply as strongly. Something else I wanted to mention is that the master strategy really focuses on trading pullbacks within the DR-IDR range. So logically, he might say, hey, now that price has closed above the DR, we know that the DR, the low of the DR, is the low of the day. So if price pulls back within the DR and gets close to the low of the day, likely there will be a reversal because it probably won't take out the low of the day. And something else that is mentioned more in his later videos is a couple other additional filters. And I'll just pull up TradingView now to be able to talk about this visually. There's both an inter-session and an intra-session filter. Specifically here, the intra-session filter, which is also mentioned by Artie in the moving average, would state that you only want to take longs, let's say in the London session, if the London session had a bullish open to close of your DR. So for instance, the difference between the open and the close price of the DR would be a positive difference. That would mean you should go long. Whereas, for instance, here, the difference between the open and the close price of this DR, actually it went down. So that means you should only be taking shorts. So that would be the intra-session filter. The inter-session filter, which is also mentioned by the moving average, is that you should look at the current DR, or in this case it's the LDR, relative to the previous DR. So this would be comparing the LDR to the ADR, and we should only be taking shorts if we are below the previous session. So here, this would be a perfect example for a time where a short setup might be deemed appropriate according to the filters, whereas we have a negative intra-session movement, and the inter-session movement is also bearish. But this is an example where you probably should not have taken a short because it did keep going upwards. So to return to the PowerPoint, to be able to test this concept, it would have been a little bit more challenging to test pullbacks, as there's a little bit of subjectivity. So to adapt this to an algo trading approach, we wanted to really test a very mechanical approach, trading breakouts of the DR. And ultimately, this is adapting the system to more of an algo trading gold scalping approach. So before the purists come after me, this is not a pure backtest of the original concept. It's taking the concept and using it to test a new system. And how that system would work, going back to the chart, is let's say we find ourselves a DR, such as this one here. We would place buy stops and sell stops at the range of the DR, and upon break of the DR, price would effectively, or sell would, in this case, would trigger, and you would be able to scalp profits. So it's essentially using a breakout system with the concept of the DR in order to create a modified approach. And here, we can actually open MetaTrader to backtest this. So we created an expert advisor here where we can test all of the different DR sessions, the ADR, the LDR, and the DR. And in this case, we are only going to be testing the DR, the New York session. So here we define the range, which is the exact same one as defined by the master, between 9:30 a.m. Eastern Standard Time and 10:30 a.m. Eastern Standard Time. We use a 1-to-1 risk reward, so between stop loss and start trail, with a trailing stop loss to give us a bit of an additional boost. And here I'm going to start us off with both the inter-session and the intra-session filters set to false. If you are interested in learning more about either of these filters, I highly recommend you watch the moving averages video outlining this strategy. Here, we can now test between October of 2023 and October of 2024. And yes, I will let it rip. So once this loads, we should be able to see how these exact parameters work. And here our backtest was completed. So we're seeing a $10,000 balance would have become roughly a $15,000 balance. And we're seeing a win rate of approximately 50% with a better risk reward. This is due to the use of our trailing stop loss. So ultimately, this shows that there is some promise here. I will go back again quickly and now test, for instance, an intra-session filter. We can see that it did trade a bit less, so the returns are not going to be quite as good. However, our win rate did improve. So really the purpose of this video was to show that there is definitely a lot of promise and premise behind the DR/IDR concept. However, in order to use it in an algo trading approach, we would need to add some modifications, perhaps some alternative filters. But something which I encourage you guys to test in your own trading strategies is to test breakouts of the DR/IDR. So instead of looking only for pullbacks, perhaps on certain high volatility days, you can also look for breakouts of this range. So please let me know in the comments if you'd like me to test a particular variation of this. I'd be happy to make another video so that we can really get to the bottom of this and see how these concepts can be used to develop excellent mechanical trading systems. Also, please stick around for a free expert advisor. Take care, have a good day. Before you click away, if you're looking to get a real expert advisor, here at Prosperity Algo Solutions, we're currently offering our Golden Time Bomb system based on automating the London breakout and opening range breakout 100% for free. Watch the pinned video to find out more and to get access.